Hello, everyone. Welcome, and thank you for attending our final webinar of the year. My name is Aaron Arnold, and I will be taking you through a classic holiday movie themed presentation today where we visit the past, present, and future. But before we begin, and as always, please take a moment to read our standard disclosure, stating that I believe the slides and presentation to contain accurate and up-to-date information. Now, let's begin our journey through the past, present, and future. Although we don't believe in driving the car looking out the rear view mirror, or the side view mirror in this case, it is important to understand the past so that we can learn from it and apply these lessons to the future and the present. There has always been a reason and an excuse for not investing. Y2K, global financial crisis, elections, COVID, and this past year has been no different. The Russia-Ukraine war, rising rates, COVID lockdowns, supply chain issues, and inflation have put the markets under a lot of pressure. Inflation has hit a 40-year high, which takes us back to the early 80s, which this slide shows us. And I'm sure we're all feeling that inflation in one way or another. The good news is that inflation has started to ease and roll over recently. And the markets have definitely felt this pressure. The NASDAQ is down over 31% this year. The S&P 500 is down over 18%. And even the low risk Vanguard Total Bond Index is down over 12%. And everyone's favorite way to gamble, favorite cryptocurrency, Bitcoin, is down over 60% this year. Now, I also want to mention that although this is how the markets have been performing, our standard balanced portfolio has seen nowhere near these declines. We have even outperformed and protected better than your low risk bond market. Nevertheless, it has been a tough year everywhere for everyone. In fact, this has been the worst performing year for bonds since 1976 and the first year of back-to-back negative returns. And although we can't and shouldn't ignore the past, and I certainly do not mean to make light of it the last year that we've all been through, we need to listen to our friend Timon. You've got to put the past behind you. History never repeats itself, but it does often rhyme. So we can always learn from the past and use this in the present and use it to plan for the future. This takes us to the present. As I stated, there are always reasons not to invest. And as we can see on this slide, there has been a lot of reasons dating back to 2002. But there is at least one good reason to stay invested. History has rewarded those who stay invested over the long term. This slide shows how an initial investment of $10,000 in the TSX in 2002 was worth over $47,000 by the end of 2021. Even while going through all those ups and downs like the 2008 financial crisis. That is almost 5 times as much. Furthermore, timing the market is an impossible task. It isn't about timing the market, it's about your time in the market. And this slide shows how missing the best days in the market since 1986 would have impacted your returns. And since we have no idea when those best days will occur, the only way to guarantee not missing the best days is to stay invested. An initial investment of $10,000 made in the TSX in 1986 would be worth approximately $170,000 in June of this year if you had stayed invested. However, if you missed just the 10 best days, your investment would be worth less than half at a value of approximately $80,000. If you missed the 20 best days, your investment would have been worth only about $50,000. And if you missed the best 60 days, it would have been worth only approximately $13,000. And again, we have no idea when those best days will occur, and they often occur after rough markets. The only way to ensure that we don't miss these best days is to remain invested, to stay invested and focus on the long term. Speaking of long term, a consistent message from our team has always been to focus on the long term for your investments, at least 3 to 5 years or longer. If you need cash in the short term, you should keep your cash in hand. It should not be invested, and this slide shows you why. This slide shows a range of stocks and bonds performance since 1950. As you can see, over a 5-year rolling period, a balanced portfolio of 50% stocks and 50% bonds has never been negative, versus a 1-year rolling period has had returns ranging from negative 15% to positive 33%. In fact, over a 1-year period, you have approximately a 20 to 25% chance of losing money. That means once every 4 years, you will have a negative return. If you are invested for at least 3 years, you have over a 90% chance of earning a positive return, and therefore less than approximately 10% chance of losing money. And as I mentioned, a balanced portfolio has never lost money over a rolling 5-year period. That is why investing for at least 5 years and focusing on the long term is so important. And the good times, the bull markets, have lasted a lot longer than the bad times, the bear markets. That is what this slide shows. The average bull market, good market, in Canada has lasted about 41.6 months versus the average bear market, bad market, has lasted about 8.2 months. The good times have lasted approximately 5 times longer than the bad times. So these are some of the reasons why we should stay invested, not panic in the short term, focus on the long term, because that will give us the highest probability of success. Now we're going to look into the future in 2023 and reasons to stay positive. The stock market has historically been a leading indicator of the economy, not the other way around. Markets tend to peak 7 months before recessions begin and usually recover 6 months before recessions end. The S&P 500 peaked in January, for example, this year. What this means for investors is basically that the markets should begin to recover before everything else does. It is the first thing to drop, but the first thing to recover. And I hope and believe that most of the pain is behind us. Now, I talked about inflation before and how high it is, but inflation does have some silver linings. And because of the holidays and I'm wanting to keep things positive, I thought I'd give you a couple examples. As a result of indexing, certain limits and numbers have increased to your benefit. Your TFSA, for example, the limit has increased from $6,000 per year to $6,500 for 2023 and $88,000 of total cumulative room. So come January, we can all deposit $6,500 into our TFSA. Similarly, the RSPs have increased their limit. They've gone up to about $31,000 from a previous, approximately $29,000. And then there are taxes. First of all, as a father of 3 little girls, you might have noticed the Lion King slide. I think it's important to teach your kids, really important to teach your kids about finances and taxes. And I agree with the great Bill Murray that, the best way to teach your kids a quick, hard, fast lesson about taxes is by eating 30% of their ice cream. But back to the taxes and the good parts and the silver lining about your taxes. Surely you must be thinking that there's nothing good to say about taxes, especially at a time like this. But that's where you're wrong. I'm here to deliver that positive message. And don't call me Shirley, another classic 80s movies quote from Leslie Nielsen. That one's for you, John. So when we're looking at taxes, all else being equal, an investor earning the same amount of income in 2023 as they did in 2022 will pay slightly less in taxes due to the increases in tax brackets. For example, if you earned $53,000 in 2022, you would have had to pay 28% in tax on the last $3,000 you earned. Now, if you earn the same $53,000 in income in 2023, you will only be taxed at a top rate of 22% and under for this amount. And this applies to all tax brackets and for everyone. So if you earned $100,000 in 2022 and you're going to earn $100,000 in 2023, you will pay less in tax in 2023 than you paid in 2022. And we can see those amounts on this slide, how they've increased for all the different brackets. Additionally, as a result of high inflation and indexing, your pensions will also increase in January by a larger amount than usual. And I'm sure this will be welcomed by everybody after expensive holiday season. So the cost of living adjustment, COLA, your municipal pension plan will go up by a much larger amount than has previously, as they remove the cap of 2.1%. We don't know exactly what it will be, but it could be upwards of 5-6% increase for 2023. So when you get your 2023 first checks show up, you'll notice that it was higher than the ones you're receiving back in 2022. And it's same for CPP and OAS. OAS is increased quarterly, so you'll see it go up. Additionally, OAS clawback has been increased to almost $87,000 from the current 82, so up about $5,000. So if you were on that bubble before of getting your OAS, or you're getting a little bit of your OAS clawed back, and your income hasn't increased, then you may not be getting that clawed back anymore, which is great. Lastly, I want to remind everybody about the new IA mobile app. I'm not sure if this is from the past, the present, or future where this fits. Apps still seem to me a little bit futuristic in some ways, but at the same time, I can't help but feel it's about time we have an app. So nevertheless, in the present, it's here, it's available, and you can go and download it at the Apple Store, Apple Apps, or on your Android. It's available there. And once you have it, you can access all your account information, statements, performance, account holdings. And later on this in 2023, during tax time, you'll be able to access all your tax slips and tax information there as well. So it can be really useful and handy and easy to access on your phone. Thank you for watching. And if there's anything else we can do for you, please don't hesitate to reach out and let us know. And I would like to wish everyone happy holidays and a happy new year from my girls, Santa, my family, and all of us here at Love Financial. Enjoy the holidays, and we look forward to seeing you in 2023.